Welcome to the Deep Dive, your shortcut to being well-informed. Today, we are diving into Element Solutions Q2 2025 earnings call. And this quarter really gave us some pretty interesting clues about where industrial materials might be heading, especially, how Element is positioning itself. Are they really becoming this high-tech player, or is it more just riding the current wave? Let's unpack it. Okay, so Element Solutions, they really closed out a strong second quarter. I mean, they sailed past what analysts were expecting. Their non-GAAP adjusted EPS landed at 0.37 cents. That was just a bit higher than the 0.36 cents consensus. And just quickly, that non-GAAP number, it basically cleans up the view, right? Takes out the one-off stuff, so you see the core business profit. Then revenue hit $625 million. Pretty impressive, beating the consensus, which was, around $587 million.
Yeah, exactly. And those numbers, they tell a good story. That $625 million, it means 2% reported growth year over year. But maybe more importantly, the underlying organic growth was 6%. That's, growth from the actual business, not just buying stuff. Profitability looked good too. Adjusted EBITDA hit $136 million,
okay,
which works out to an adjusted EBITDA margin of 21.7%. Pretty healthy.
Definitely.
And they pulled in $73 million in cash from operations, which netted out to $59 million in adjusted free cash flow. So you add it all up, it really paints a picture of, solid execution, and the market definitely reacted positively.
Right. Okay, so let's peel back the layers a bit, dig into the segments, because one area really shone this quarter, didn't it? The electronics segment. That's 5 quarters in a row now of high single-digit organic growth.
It is, yeah. 5 straight quarters.
They reported a 12% increase overall, and like you said, 9% organic growth. That kind of consistency, it feels pretty strategic.
Oh, absolutely. And what's really pushing this is how broad it is. It's across all 3 parts of their electronics business. A huge piece is the ongoing hyperscaler investment. The giant tech companies building out massive data centers.
Right, the cloud infrastructure.
Exactly. So think strong demand for metallization chemistries for these really complex circuit boards and specialized thermal management stuff, absolutely critical to stop powerful chips overheating, plus advanced chip packaging chemistries.
But you mentioned specific areas surging.
Yeah, wafer-level packaging products. That's about building tiny, powerful chips right on the wafer. They jumped over 20%, driven by the ramp-up in, the latest tech nodes. And their power electronics side saw double-digit growth, too. They're getting customers beyond just EVs now, new manufacturers in Asia and Europe.
So it's a definite shift then toward these higher value B2B markets.
A very clear and I'd say successful shift, yes.
And innovation seems key here. Management talked about getting traction with thermal management for high performance computing chips. That helps get more power into smaller spaces, right?
Precisely. Power density is the name of the game there.
They also mentioned progress with their active copper deposition tech. Couprian, they call it.
That's the one, Couprian. It's designed to solve some really tricky thermal and power challenges for customers.
And it's not just research. They're actually building something.
They are. They're constructing their first mid-scale active copper manufacturing site. Should be up and running by year-end, they expect. That's a real commitment.
Okay, so electronics is firing on all cylinders. But then you look at the other side, industrial and specialty. That saw a reported decline of 16%.
Yeah, and on the surface, that number looks a bit worrying, doesn't it?
It definitely catches your eye.
Right.
But there's usually more to the story with these headline numbers. What's going on there?
Exactly. That reported drop, it was mostly because they sold off their graphics business. That divestiture really skewed the numbers.
Right. So if you take that out.
If you exclude the graphics sale, the segment actually grew 1% organically, which, considering the environment, shows some real resilience.
Okay, 1% organic. That's a different picture.
It is. Their main industrial surface treatment business, making materials stronger, more corrosion resistant, that kind of thing, it held stable or even grew adjusted EBITDA. That's despite volume pressures. They managed it through productivity actions and holding the line on pricing.
Makes sense.
And even their offshore business, deep water oil and gas support, that grew 15% organically. They were catching up on projects that got delayed earlier.
15%. Wow.
Yeah, impressive catch up. So it really shows they can adapt and, protect profitability even when parts of the market are tough.
Okay, let's switch to margins. Always crucial. In electronics, the adjusted EBITDA margin, if you exclude the pass-through metal costs, it looked like it was down year over year. Given how well the top line did, what explains that apparent dip?
Good question. It's mainly 2 things, and they're largely temporary effects, according to management. First, after selling graphics, the way they allocate some shared corporate costs changed.
Huh.
So think of central admin costs, R&D overhead maybe, stuff that used to be spread over a bigger base, including graphics. Now more of it lands on electronics, making the margin look lower on paper.
Even if the core product profitability is still strong.
Exactly. The second factor is they are spending a bit more. Incremental operating expenses to fund R&D for Couprian and other growth projects within electronics.
Right, investing in the future.
Correct. But the key takeaway is that the actual margins on their core product lines within electronics are still healthy and stable once you adjust for these allocation changes and investments. Management sees these effects as transient. They expect to get back to their historical, 30-40% incremental margins going forward.
Got it. Okay, shifting gears slightly, capital allocation. They bought back shares in Q2.
They did. About 0.9 million shares for roughly $19.5 million.
And that sends a signal, doesn't it?
It does. They still have a huge amount left on their buyback authorization, about $562 million. So it signals confidence in their valuation, definitely, and a commitment to returning cash.
They seem pretty clear that buybacks were the best use of capital.
Very clear on that for Q2. They also filed what's called a universal shelf registration. It's pretty routine, basically gets them pre-approval to potentially issue securities down the road.
So flexibility, not necessarily an immediate plan to issue stock or anything.
Exactly. Just standard financial housekeeping gives them options for the future.
All right, now this is where it gets really interesting for investors, the outlook. Management sounded optimistic, raising the full-year guidance.
They did. Full year 2025 adjusted EBITDA guidance is now $530 million to $550 million.
And for Q3 specifically.
They're expecting between $140 million and $145 million. That's about a 5% step up sequentially from Q2. So yeah, a strong vote of confidence.
What are the key drivers they see for the rest of the year?
They expect the leading edge electronics side, especially high performance computing data centers, to stay strong. Industrial demand, they think, will probably look similar to the first half.
But some caution too.
Definitely. They're still cautious on consumer electronics and EV volumes. Those are harder to predict right now, so they represent both potential upside and risk.
And tariffs. Still a factor.
Yeah, the guidance range is a bit wider than usual, partly because of uncertainty around potential tariff impacts. They're being prudent and factoring that in.
Okay, so in this world of, shifting trade winds and tariff talk, which seems constant now, how does Element Solutions position itself? How do they handle that uncertainty?
That's actually one of their key strengths, management argues. They have this very broad geographic footprint, but it's also very localized, meaning they source, manufacture, and provide technical support close to their customers all around the world, not just one or two giant hubs.
So that helps buffer against tariffs hitting one specific region.
Exactly. It helps mitigate the impact on their costs, and it lets them support customers better as supply chains maybe shift or realign.
And they're investing in that.
They are. They highlighted a new research center opening in Bangalore, India, plus new application labs in Thailand and Vietnam. It's about being hyper-local, essentially, more resilient.
Okay, let's circle back to Couprian. That active copper tech you mentioned. Sounds like it could be a really big deal. What's the latest there?
Well, the interesting thing is demand is apparently way ahead of what they can currently make.
Really?
Yeah, they've actually had to limit who they engage with because they just couldn't produce enough lab-scale samples fast enough.
So that new production line coming online end of year is crucial then?
Absolutely crucial. That first mid-scale line is designed to ease that initial bottleneck, but based on what they're seeing now, demand-wise, they think they'll probably need another full production site within the next 18 months or so.
Wow. So the demand is real.
Seems like it. And they see Couprian as an above-average margin product because it solves real pain points for customers. It's genuinely new material science for power density and thermal management in advanced chips.
And they have a long-term target for it.
They do. Over $100 million in revenue by 2030. They sound very confident they can meet or beat that. This isn't just another product line. It's potentially transformative for them. Could shift them from being seen as just a material supplier to, well, a critical tech enabler.
So putting it all together, these Q2 results, they really do highlight that strategic shift towards the high-growth electronics markets. Seems like the long-term plan is working.
I think that's fair to say. That consistent high single-digit organic growth in electronics quarter after quarter, it shows they're penetrating the right markets, advanced packaging, thermal management. These are critical areas. And by focusing there while, trimming some legacy businesses like graphics, they are definitely boosting their overall growth potential.
And the beat on revenue and EPS, plus raising the guidance, that signals strong execution.
Yeah, strong execution and solid demand, especially in those B2B tech applications.
Plus the buybacks reinforcing that confidence.
Right. Now, connecting this to the bigger picture for investors. Yes, there are macro uncertainties. Tariffs, potential slowdowns in consumer electronics or EVs, those are real risks. But Element's localized footprint and diverse customer base should help them navigate that better than some. And performance-wise, the stock has significantly outperformed the broader materials sector ETF, the XLB, over the last 1, 3, and 12 months.
Interesting.
Yeah, and you see positive analyst sentiment, price targets going up. It suggests the market is maybe starting to re-rate the stock as they prove out this electronics leadership and hit their numbers. It really reflects that strategic transformation they've been working on.
Okay, let's move to our This Is Not Financial Advice segment. Time to get a little speculative, but maybe strategically interesting. Given everything we've talked about, the strength in advanced packaging, thermal management, and especially this Couprian active copper initiative with the new site coming online, here's a thought maybe for those with a higher appetite for risk.
Okay, let's hear it.
What about something like a long strangle option strategy on ESI?
A long strangle. Explain that a bit.
Okay, so very basically, you'd buy an out-of-the-money call option and an out-of-the-money put option, both with a longer expiration date, maybe 12, 18 months out.
Right. Betting on a big move, but not sure which direction.
Exactly. The thinking is, if this Couprian active copper thing really takes off, if it revolutionizes power density like they hope, that new manufacturing capacity could send the stock flying way higher than anyone expects now.
Okay, that's the upside scenario.
That's the upside. But on the flip side, what if there are big delays getting that site running? Or what if those EV market headwinds bite harder than expected and really hit their power electronics business? Then you could see a significant drop.
So the strangle profits if the stock makes a really big move, either up or down, covering the cost of buying both options.
Precisely. It hedges against those two extreme outcomes. You're leveraging the potential volatility around this Couprian story, which feels a bit binary right now.
Yeah.
Big success or potential setbacks.
It's definitely high risk, high reward. Options decay, you need a substantial move. But yeah, if they nail that $100 million plus target for Couprian by 2030, the volatility could be significant. An interesting way to play the uncertainty.
Just a thought experiment, of course. So let's recap. Element Solutions, really strong Q2, powered by that electronic segment, focused on high growth niches like packaging and now this active copper push. They raise their guidance on confidence.
Yeah, it really paints a picture of a company successfully transforming itself, finding growth in these critical tech sectors, shows real strategic vision and execution.
Absolutely. Yeah. Now, remember, everyone, this discussion is purely for informational purposes. It is definitely not financial advice. Always, always consult with a qualified financial professional before making any investment decisions. And as we wrap up today's deep dive, here's something to think about. Element Solutions is making a big bet with Couprian on the future of high-performance computing. If a material science breakthrough like active copper truly delivers, how could that reshape not just this one company, but maybe the whole semiconductor landscape in the next few years? Feel free to share your thoughts.